when you think of Spotify, you probably think of your favorite playlist, right? Or maybe that podcast you just can't stop listening to. It's that little green icon that's just part of our daily lives now.
I mean, it's the soundtrack to pretty much everything we do. Our commute, our workouts, you name it. We know the product inside and out.
But see, underneath that friendly app is a whole other story. It's a financial story that's way more complicated and honestly way more fascinating than you might think. And it all leads to one heck of a question.
So let's start with the story that everyone can see, the one that looks like a runaway success. We're talking about the money, the revenue coming in the door.
Just look at this trend. I mean, it's a thing of beauty, isn't it? It just goes up and up. We start back in 2018 at just over $6 billion. Then it climbs past $12 billion by 2022, and it just keeps on going. The trajectory is undeniable.
And that brings us to today. We're talking nearly $17 billion in annual revenue. Let that sink in. That is a massive, world-class number for any company on the planet.
And listen, this isn't just some one-time lucky streak. We're seeing consistent double-digit growth every single year. By any traditional metric you want to use, this looks like a super healthy, fast-growing business, a real growth machine.
Okay, so with all this growth, all this cash pouring in, you'd think investing in Spotify stock would be a total no-brainer, right? I mean, it seems like an open and shut case, a simple success story.
Well, here's where things get interesting. This is where the story takes a huge turn. Because, you see, the story of a company's revenue and the story of its stock price, they aren't always the same thing. And some analysts looked at that stock price and saw something that just didn't make sense.
To really get what's going on, we have to flip our thinking. We need to stop looking at what Spotify has already done and start looking at what the stock market is betting it has to do in the future.
And that's exactly what some analysts did. This quote comes from a team that decided to work backward. Instead of trying to guess what Spotify's stock should be worth, they started with what it was worth and asked a totally different question. They used this tool, a reverse DCF model. Now, don't worry about the jargon. All you really need to know is that this tool basically calculates the future that a company must create to make its current stock price look reasonable. It's like it uncovers the hidden promises that are baked into the price. And what they found was kind of shocking. For Spotify's stock price to make sense, the company doesn't just need to keep doing well. No, it needs to take two absolutely gigantic leaps. First, keep up that massive growth. And second, become profitable on a scale that it has never ever seen before. And folks, this is where the story goes from interesting to just wild. Because when you put actual numbers on those two giant leaps, the expectations are, frankly, almost unbelievable. So get this, to justify its stock price at the time, the model showed that Spotify's revenue had to grow by almost 28% every single year for the next 15 years. If it did that, it would take its revenue from where it is today to $562 billion. To give you some perspective on how huge that number is, $562 billion is more money than Apple, yes, that Apple, currently makes in an entire year. So the stock price isn't just expecting growth, it's expecting Spotify to become one of the biggest, most dominant companies on the face of the earth. But hold on, that's only half of it. Remember that second leap, profitability? The market is also expecting Spotify to achieve a return on invested capital, basically how good it is at turning cash into profit, of over 2,400%. For context, the absolute best, most efficient companies in the S&P 500, they top out around 450%. This quote really just says it all, doesn't it? The market isn't just hoping Spotify gets profitable. It's pricing it as if it's going to become more profitable than any major company we've seen in recent history, by a factor of 4 or 5. It's a lot. So what would it actually take for Spotify to hit that $562 billion revenue target? Well, if you look at projections for the entire global market for music, radio, and podcasts, Spotify would need to own 287% of it. Yep, you heard me right, not 28.7%, 287%. Nearly 3 times the entire global market. Okay, so we have these two completely different stories, right? On one hand, you've got this fantastic revenue growth. On the other, you've got these completely astronomical market expectations. what in the world are we supposed to make of all this?
Well, it all boils down to a really important lesson. A company can be a huge success, a product we all love and use, while its stock price is telling a completely different story, one that might be detached from reality.
Here's the simplest way to think about it. Revenue, that's the report card. It tells you what a company has done in the past. But the stock price, that's a crystal ball. It reflects what investors expect the company to do in the future. And that gap, the gap between what's happened and what's expected, that's everything. That's where all the risk and all the opportunity is hiding. So the next time you see a company with a stock price that's just soaring, take a second and ask yourself this question. Are you looking at the reflection of its amazing success so far? Or are you looking at a price that is demanding a future that is next to impossible? Thinking about that can make all the difference.